Friday.Forex.Today. What an awesome time to be alive. The markets are moving. The world is still free. Capitalism still reigns. Enjoy it while you can. Enjoy it while you can, man. You guys ready to go? All right, well, we'll have to look at the pound. We'll have to look at the dollar. We'll have to look at the yen and the Swiss franc. Might as well take a look at Aussie and Kiwi and CAD. Do some gold, do some oil, look at exotics, talk about some fundamentals, maybe sing some songs, tell a few jokes, have some fun, and then maybe some kumbaya at the end. Seems like a good strategy, huh? So without further ado, let's go! Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Great coffee this morning. Thank you, coffee minions. I got a new hat. What do you think of that, huh? Nice. 1636. Very cool. Thank you, clearance section. Thank you, clearance section. Nice. Good time of year to buy a baseball hat. Anyways, hey, my name is Wayne. Nice to meet you. I'm the chief currency coach of a lot of different things. So, the sponsor of our organization, however, is Traders Way. Oh, thank you for that. Appreciate that. Yeah, you like the hat, yeah. I invite you to visit Traders Way. I trade with Traders Way. Why? Fast execution speed, world-class customer service, competitive fees, and amazing, ridiculous, awesome swaps. Cool. Visit tradersway.com. Open a demo account and check it out for yourself. Once you have MT4 installed, swing back to this video and download my chart templates. And then you got the complete toolkit, a wonderful broker, and an amazing tools to trade with. You can come to these webinars every weekday at 8 a.m. New York time. Oh, coffee's over here. And I'll be here to help you along your way to success. So daily webinars, the correct trading tools, and an awesome broker. That's the trifecta. Okay? There's your base, your foundation for success. So put those all together. If you need some education, consider going to fxbootcamp.com. Cool. So, without further ado, let's get going. Ciao! Nice. Let's move that down. Oh, the wrong thing moved. Hang on, I'm trying to get that logo down a little bit. There we go. You notice I minimized the moving graphics, so they're still there, but they're much, much, much less. None on the sides. So, some people said they were a little too distracting, so I made it less distracting. Highlander, high quality, what? Oh, you mean on the swing trading group? The first one we did, I think it was 54 minutes. So that's in the swing trading course. And then I'm doing the second one today. By the way, my new setup is awesome. Thank you. Appreciate that. Okay, so rules of engagement here. Treat everyone in the chat with respect. If you're a heckler or a spammer, find a bridge. You know what to do. Ask questions here, get involved, and I will try to cover anything you want me to cover. I don't have an agenda per se. I am simply bringing many years, thousands, tens of thousands of hours of experience to the table, and I'm willing to open up the box and let you peek inside. Can you please give me some hint of what quantitative easing is? Is that the question? SWS? S1W. I always want to call you S1W. I don't know if anyone here is a Public Enemy fan, but that's old school. Back! Caught you looking for the same thing. It's a new thing. Check out this supreme. Oh, I'm living low next to bass. Turn up the radio. Yeah. They're claiming I'm a criminal, but now I wonder how some people ever know your enemy could be your friend or guardian. I'm not a hooligan. I rock the party and clear all the... Oh, man, I can go for hours. Anyways. Yeah, okay, cool. What is quantitative easing? Okay, great question. By the way, there's an entire training course about this at SWS. There's an entire training course. So at FX Bootcamp, it's called the Fundamentals course. I'm going to probably redo it. I think I'm going to redo every single course. Just, it's always on my mind. And I think I would rename the Fundamentals course Central Banking or Monetary Policy, something like that. Okay? So the real answer I could give you is about 18 hours long. So consider doing that at SWS. That's at fxbootcamp.com. Okay. All right. So what is quantitative easing? Quantitative easing. My camera looks a little funny here. Quantitative easing is a central bank buying bonds. Now you're like, well, they always buy bonds. Yeah, that's true. Yes. I'm not joking. Maybe it's not 18 hours, but it's probably 15 hours. But it might be 18. Oh, man, that's so good. Okay, but quantitative easing really comes down to this. The central bank, let me do this. How am I going to do this? Talk to me, Goose. I guess we'll do it this way, and we will... And we will call this interest rate, right? And this is the quantity of, am I doing this right? Quantity of money? Is this the right? Hang on, let me think about this. Is that the demand? It's the demand and quantity of money. I think I got this right. Hang on. So let's do this. This is the demand curve. Okay? The demand curve is unique when we talk about monetary policy. Typically, when you draw something like supply and demand, you have a demand curve that's low, sloped down, and a supply curve that slopes up. Can anyone describe to me why a demand curve is typically sloped down? Type in a question mark if you don't know. You always have to label your charts. I've been well trained. Okay, imagine you want to buy some widgets. Okay? Oh, I got this backwards too. Hang on. Okay, imagine you got some widgets. Is this right? Hang on, let me think about it. No, I had that right. I had that right. All right, okay, cool. So, this is money now. When the price is low, you want to buy a lot. Okay? The number and the price. So the price is low, so you buy quantity. So the number, it's really a Q. The quantity of the units. Okay? The quantity of units is high, so you can do this like 1, 2, 3, 4, 5, for example. And then the quantity of money, or the price, 1, 2, 3, 4, 5. Okay? So, as the price falls, as the price rises, so now the price is changed from $1 per unit to $5. The new equilibrium price would be, or the quantity would be this number. So the quantity purchased would go from 5 to 2. So quantity goes down as the price goes up. Does that make sense? And then you use supply and demand to start figuring things out like, well, what is the proper price? For me to charge. Okay? And the proper price for me to charge is $3, and at $3 I'll sell 3 units. 3.5 units. Okay? All right, so when we talk about money supply, the demand curve, and I need to label this properly, come on. The demand curve is vertical because it's just simply the amount of money. That's it. It's just demand is constant. Money is money is money is money. But you can shift this stuff around. You can add money to the economy, and you can reduce the amount of money in the economy. And this is the basics of central banking. This is what a central bank does, by the way. Have you ever heard that China manipulates their currency? Have you ever heard that? Yeah, well, this is, if a central bank adds money or reduces the quantity, this is the quantity of money, the amount of money. If they added, remember quantities here, right? Let's say 1 trillion, 2 trillion, 3 trillion, 4 trillion, 5 trillion. So if we shift this curve to the right, it's more quantity. If we shift it to the left, it's it's less quantity. That's what central banks do. And that, by definition, is manipulation. They're either adding money or they're subtracting money. And so China is adding or subtracting money. It's like, well, sort of, not really. Okay, Famboic says a quantitative easing is a fancy way for printing money. Well, sort of, not really. That actually gets done through the fractional reserve banking system. Okay? But I'm just saying, this is, every central bank on the planet does this. It's just monetary policy. Every central bank does it. So, but whatever. Okay, so let's kind of, what is quantitative easing then? Let's finish this thought, and I'll get rid of all of this. And thank you for allowing me to prepare for this detailed presentation. So luckily I got it in my brain. All right, cool. So the Fed comes in and buys bonds. So remember, the question is, what is quantitative easing? The Fed buys some bonds. 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 Okay. So this is called an open market operation. What that means is there's no special place for the Fed. Okay? The Fed deals with one of the 12 bond dealers in New York City. This is why the Federal Reserve Bank of New York does all the open market operations, and the president of the New York Fed also is a permanent member of the permanent voting member of the FOMC. None of the other, all the other Fed presidents, they rotate as far as voting. They all attend the FOMC meetings, but only a small percentage of them actually vote. They all deliberate, but only a small percentage of them actually vote to raise or lower interest rates. The president of the New York Fed always votes. Why? Because they're actually the ones that actually do these open market operations. So when I say the Fed buys bonds, I mean there's a desk at the New York Fed that actually goes out and they buy the bonds. There's only 12 bond dealers. I might be wrong on that. There might be 14 or something, but there's only a few. So like JP Morgan, Goldman Sachs, these are the places where you go to buy bonds directly, right? Not your Raymond James or something. So anyways, because that's an aftermarket, secondary market. So anyways, the New York Fed calls JP Morgan. Sup, brother? Need some bonds, brah? Right? Okay, great. So JP Morgan sells the Fed some bonds. They front run them first. For sure, man. They front run them. Faux show. They don't give them a fair price. No way. The Fed doesn't care about the price because they just use electronic money. So anyways, here's what goes down. Okay? Here's what goes. Let's label this process now. So the Fed calls JP Morgan, JPM. Okay? JPM gives Fed the bonds. Let's say $100 million. And of course, that would be hardly anything. 100 million would be nothing. Isn't that interesting? Okay. What does the Fed give JP Morgan? Yes, Chuck. Yes. No, JP Morgan gave the Fed bonds. What does the Fed give JP Morgan? It's not a trick question, yo. What's the exchange? The Fed buys bonds. What does JP Morgan get? Money! Moolah! Paper scratch. Paper stacked. Boom. Okay? Cool. What does now JP Morgan do? JP Morgan puts it in their bank. Right? Because it's their bond desk that actually does the transaction. So the bond desk puts the money into their bank. And what does the bank do with it? What do banks do? They loan it out. Absolutely. They loan it out. That's what banks do. It's a deposit in JP Morgan's bank account. So the bank says, thank you. And now it might be their own bank account. It could be a different bank. It doesn't matter. Okay? Here's the funny thing. 20% of JP Morgan's money gets parked at the Fed anyways. Or was it 10? Boy, I'm getting old, man. Is it 20 or 10? 20, isn't it? What's the reserve requirement ratio in the United States? I can't believe I'm asking that. I'm not getting enough sleep or something. Is it 10 or 20? 10. It's 10. No, it's 20. 15. 10. It is 10, isn't it? Gee whiz. Is it 10? I got to take my course. Yeah, it's 10. As soon as I wrote 20, I'm like, that's really high. That doesn't sound right. My bad. The RRR is 10, yo. Come on, wanksta. Okay, 10% gets parked at the Fed. So the Fed gave JP Morgan money, and then JP Morgan gives 10% of it back to the Fed. Nice. And the other 90 cents on the dollar stays in the bank, and the bank loans it out. Who takes the loan? Somebody. What do they do with the loan? Well, why do you take a loan? Has anyone ever borrowed money to save it? No. You borrow money to use it. So they use the money. What happens? They buy something with it. What happens, right, with that exchange? Well, they get whatever asset they bought, and that person now gets the money that they borrowed from JP Morgan's bank. So it goes to a different bank. 10% of that goes to the Fed, and then that gets loaned out. And that's the fractional reserve banking part of it. But here's the thing. The part that's quantitative easing, okay, is the fact that the Fed gave money in exchange for the bond, okay? And now that has entered the market. It didn't exist before because the Fed actually manufactured it. They didn't print it. Okay? So the first thing that happens is the money supply increases from, let's say, from 4 to 5. So now this is demand 2, demand curve 2, and we've shifted from 4 to 5. The amount of money in the economy has gone up. Okay? Now, as I said, JP Morgan puts in the bank. Okay? 10% goes to the Fed, 90% get loans out. Somebody borrows the money, right, from that bank, spends the money. They spend it, there's a transaction. Right? That money goes to a new bank. 10% from the second bank now goes to the Fed. And from the second bank loans out their 90%, which then gets borrowed by somebody who then spends it on something. You see all these transactions? They buy something, they use the money somehow. That goes to another bank. 10% gets parked at the Fed. 90% of that goes loans out. And what happens is the amount of money grows. Okay? The formula for this, by the way, is 1 over R plus E. Okay? R being the required, 10% gets parked at the Fed. E being the excess. So you could be a bank manager now. And by the way, this is all in the fundamentals course. If you want to get knee deep into this stuff, like 18 hours of this instead of 18 minutes, you need to take the fundamentals course. Okay, SWS? But a bank manager can say, oh, well, we're risk averse. We're going to park 15% at the Fed, okay? Well, that is 10% required plus 5% excess. So that would be 1 over R plus 1 over 15, right? But in the United States is 1 over 10 is the required part. So that's typically what happens, okay? Which means when you do the math, the Fed buys, what did I say, $100 million worth of bonds. By the time we go from bank to bank to bank to bank to bank to bank to bank, right? Loan, deposit, loan, deposit, loan, deposit. This moves to the right, not 100 million, but 1 billion. And this is exactly why poor countries stay poor and why rich countries stay rich. Because the central bank adds 100 million to the economy and it turns into 1 billion. The Fed didn't print it. By the way, the Fed doesn't print money. The Treasury prints money. Okay? But the banking system creates the money. Okay? The banking system creates the money. Not necessarily, well, the Fed created 100 million. They didn't print it, they just created it. And then Americans get richer because their economy can turn 100 million into a billion. When you live in a country that doesn't have a good banking system or a credible banking system or a trustworthy banking system, then what happens? You keep your money in a suitcase under your bed or in a bag buried in your backyard or in a coffee can in your refrigerator. And it doesn't grow and it doesn't sit in the economy and your neighbor can't borrow it for their mortgage. The company down the street can't borrow it to buy new machinery and hire new employees. It just sits there doing nothing and the poor stay poor. But they're like, well, I don't trust my bank. I don't trust my government. I could, like in Argentina, people woke up one day, and this has happened multiple times. They wake up one day and they're like, oh, the government took half of the money out of all the banks. So your retirement account is now 50% lower. Thank you, right? And the government just repatriates everything or whatever, right? So if you live in a place like Argentina, for example, where you can't trust your banks, right? Or like much of Africa, I won't say all of Africa, right? But whatever. If you don't trust your banking system, and you don't trust your governmental system, then the country stays poor forever. And ever and ever and ever and ever and ever and ever and ever. Okay? Okay? Where does JP Morgan get the bonds from? Good question, Juan. Remember I said they front run it? They call up, the Fed says, I want 100 million. So they say, okay, hang on a second. And the bond desk puts them on hold, calls the Treasury. Hey, Treasury, I want $99 million worth of bonds. And they're like, okay. And then they hang up and they go, all right, Fed, I have your 100 million. I have your 100 million in bonds. And they're like, cool, we'll transfer the money. Cool, right on. All right, hey, Treasury, yeah, I got you 99 mil. I'll go ahead and transfer it to you, right? Let me know, right? Boom. The bond, right? The bonds are, so they send the Treasury 99 million and they get the Treasuries now. And then they're like, okay, got your Treasuries, Fed. Wire over your 100 mil. And they wire over and then they go, now the Fed's got their $99 million worth of bonds that they paid $100 million for. JP Morgan gets rich. Have you ever seen how much money JP Morgan profits in a quarter? Have you ever wondered, like, dude, seriously, how do these guys make $800 million? Not, right? Not in activity, in profit. You're like, how did they make $800 million profit in the last 3 months? Like, what do these guys do? And then you're like, oh, wait, they just front run the Fed? Like, they get the money for free? And of course, we're not talking 100 million. I told you the Fed doesn't do 100 million. They do tens of billions at a time. Can you imagine that JP Morgan makes like $2 billion in a day simply because the Fed called them? They're like, yeah, we need some bonds, JPM. Okay. We would like to profit, I don't know, $2 billion to do the deal. What What do you mean to do the deal? You pick up the phone and you call the Treasury. But if the Fed bought directly from the Treasury, then the money wouldn't enter the economy. You see, they want JP Morgan to earn the money because then Jamie Dimon gets a $2 billion bonus at the end of the year. What does he do? Bigger plane, bigger yacht, faster cars, nicer watch, bigger homes, right? And what happens when they buy all of that? People have jobs, they get paid too, and all of a sudden it all enters the market. Or if he doesn't do anything with it because he makes $2 billion a year, another $2 billion doesn't change anything. So it sits in the bank and the bank loans it out. Either way, it goes into the economy. Okay? SWS says, how do you know that all this shit? Because I'm the smartest person in the entire world. No, I learned it at Harvard. Yeah, don't worry about it. It's just some Illuminati stuff. So anyways, if you want 18 hours of that, I guess we need this. If you want 18 hours of that, you need to go to fxbootcamp.com and take the fundamentals course. Okay? And within your third or fourth hour, you will be thinking like a bank manager, managing the bank's balance sheet. You'll go from not understanding any of what I just told you, and in a day or two, be able to explain it to your children. And now they will respect you. Okay? Oh, how does compounding work? Does it adding trade on winning trades and add more to winning trades until the price? Yeah, I guess so. Yeah. That's all that is. I call them stacking. Okay. There's so many courses I'd like to do. I'd like to do a day trading course, and then I'd like to do basically a portfolio management course, but we'll call it like market stacking or something like that. But I don't have time, so maybe next year. Think of it. I will be done in the third week of July. I will be done. What am I going to do? It's so hard work. I can't wait for it to happen. But then there's going to be such a loss in my life. I don't know what I'm going to do when I'm done Harvard. I might maybe, I don't know, teach or something. It'd be interesting. I don't know what I'm going to do. So anyways, we'll deal with my problems later. So anyways, if you appreciated that, please click like. Would you do that for me, please? There's 45 likes now and 200 people watching. So that tells me on a percentage base, this must suck. If it is better than lame, would you please click a like for me? Thank you, Danielle. Ray Dalio, I like him. He's crazy, and I like crazy people. But I think he's made enough money now that he's a nutcase. I think his ego's gone too far. Like, I don't know. He looks nuts to me now. But parts of like his idea of like how he made all his money, the logic of his investing is very interesting. Okay. Thank you. It's gone from 43 to 83. That's not bad. Okay. About 50% of you like things, and the other 50% find it too difficult to reach out to their mouse and click the like. So, but maybe that's just how society is. But anyways, yeah, Ray Dalio, I like how he made his money and all that kind of stuff. But now he looks like he thinks he's God in his own mind or something. It's I don't know. It's nutso to me. All right. So lots of people actually didn't like what I just said against Ray Dalio. Several people just thumbs down. Okay. Sorry. Ray Dalio is a genius. I guess I'm supposed to say that. All right. Okay. Powerful Illuminati financial info. Thanks, Wayne. Cool. Yeah, it's just some Illuminati stuff. But the cool thing is, I'll teach you, man. Been 2 years? Right on. Neurotic trader. It's been 2 years. Right on. 2 years. All right, so let's just move on.com. Let's do some technicals. Okay. Right now I'm letting her run. You see this? Could be an interesting inflection point. Bow, 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 bow. What do you stink? I got to make some decisions on this one, right? Sold one here, sold one here. This could be another one. This could be a third. Stack them and pack them. Okay. Yes, I will do. Oh, Mr. T, right on. Yeah. So stack them and pack them. That's right. Oh, what is this? This is Euro Turkish Lira. Remember, that's not the only trade on here. I have to go back further and further, and there it is. So, really, so I was showing you this. So I'm here and here and here and here. So it's not really good. I'm not trying to say it's amazing, but it's just working. And even if I'm only in it for a week or two or even a few days, just remember every single trade earns 1,100% per year. Okay? Paid daily. So even if I'm only in it for 2 weeks, dude, I'm okay. I'm collecting the money every single day. All right? So that's what it's all about. Okay. Right? And this one, as you guys already know, but it doesn't hurt to mention it again, this one has now earned 500% interest. Interest only. Just the interest. Just the interest. 500%, which means I invested $100 and in interest I've already collected $500 on my $100 investment. Plus I'm up $1,000 in pips. Shizzle, right? Like sick, right? Yeah, like redonkulous. So you just want to keep doing it, keep doing it. And if you get knocked out, you're like, well, I got my share of the pie, so to speak. All right, so let's go back to this. This is Euro Rand, which we set up a couple of months ago. And it's been working fine. I waited for the double top, lower low, lower high, sold the crap out of it. Sell. And now it's down, down, down. So the next one was a fade up and down. Looks like it's just Oscar Mike now. So that one's working out too. Nice. Even Rand, for crying out loud. Even Rand. Yeah. Even Rand, baby. We're getting closer and closer to thinking about peso. But I'd like it to go up first. So I guess it's too early, I guess. But we're inching closer. So I want the up and down first, but so nothing to do there. Okay. And then USD Rand. Okay. So you can see right around October, Jerome Powell did a speech. And the complicated interpretation of the speech is the worst is over. Okay, one measure of the stock market. So the stock market is at all-time highs. Is the stock market in the United States too expensive? Well, right now, it's somewhere between $18 and $20 times 1 year's earnings to buy a stock. Okay? Is that historically high? Yeah, it's on the high side. Okay? But if you account for inflation and instead adjust the price at dividends and all that, and you adjust the price for inflation, and you look at it instead as yield instead of price, bonds are 400% more expensive than the stock market. Did you know that? Why are prices so ridiculously expensive for bonds? Does anybody know? SWS, that doesn't make any sense. So I don't know where you read that. Makes no sense. Rates are low, demand. Well, rates are low as a consequence. I didn't cover that in my little presentation here, but that's in the course, right? Because that's going to drive interest rates, but that's a consequence. And the Fed is doing it, but the demand is coming from the Fed, and everyone in the world has front-run the Fed. So the Fed, 18 months ago, for example, said, we're going to buy bonds. That's what they mean by cutting interest rates. So if everyone in the world knows the Fed's going to buy bonds, remember buying bonds from JP Morgan? So if the Fed says, we're going to buy bonds, JP Morgan and everybody else and all their clients and even you should all be front-running the Fed, buying bonds, knowing that the Fed's going to come in tomorrow or next week or next year and buy billions and billions and tens of billions and hundreds of billions of dollars of bonds. What does all of that demand do to the price? Yeah, price goes up with demand. Yeah. So right now, bonds relative to the stock market, let me remind you, the stock market in the United States is at all-time highs. So it's not a cheap stock market, right? Just by definition, stocks are not cheap. But the bond market is 400% more expensive relative to the stock market. Holy smokes. Okay. Now, why is the dollar weak right now? I'm giving you too much, right? Is this too much today? You just want me to scalp the euro dollar, right? Am I getting too esoteric? Oh, I'm getting too esoteric. Sorry. I got 7 hours of sleep last night, so, I'm just perky today, I guess. I don't know. Well, the Fed is expected to stop buying bonds. Nobody wants bonds anymore. So, what happens? Hey, no worries, Michael. If the Fed's not going to push prices up, then people are like, I'm done. They were only in it to front run the Fed. The Fed comes in and like, I'm going to buy $1 trillion worth of bonds. You're like, shoot. So you buy as many bonds as possible because you know the Fed's going to come in behind you and push all the prices up. And what happens when you believe you're at the very top of the market and demand is going to diminish? You get out. Okay? Now, let's say you're a foreigner. And you're front running the Fed. That's part of having an open market. It's all good. The only thing is you had to put money in JP Morgan first. So you had to get rid of your foreign money and buy a bunch of dollars. The dollar got strong. Remember that? And then they would buy bonds, and then the Fed or JP Morgan would sell the Fed your bonds and make a tidy little profit on that. Or more actually, what happens is just the prices go up because the Fed is buying from JP Morgan and JP Morgan is getting it from the Treasury, but whatever. Prices go up, prices go up, prices go up. And then finally the Fed says, you know what? We're seriously thinking about not buying any more bonds. You're like, oh, snap. My demand is gone. Prices are at a high and likely to fall. So as a foreigner now, you sell your bonds. You now have a big fat profit. And you bring your money home. You're like, you want to spend it. I need my yellow Lamborghini to feel like a complete person. Maybe my mother will love me more if I had a yellow Gallardo. So you bring your money home. But you're like, oh, I can't bring dollars home. I can't spend dollars in my country. I'm a foreigner. So what do? You sell them. You sell your dollars in exchange for your local currency. You buy your local currency and get rid of your dollars. The supply of dollars in the world goes up. What happens when supply goes up? There's more dollars floating around the foreign exchange market, and there's less whatever your currency was as a foreigner, right? So there's just more dollars out there now. What happens when the supply of anything goes up? What happens to the value? Not demand. Not demand, supply. This is a supply side equation, not a demand side. Supply is higher. What happens when there's more oil in the world? What happens when there's more gold? What happens when there's more houses for sale than there are buyers looking for houses? You got to lower your price if you're going to sell your house, man. There's no buyers. If you want to sell it, you got to lower your price. Price goes down. Value of the dollar goes down. Why? The Fed stopped front running. Why? The economy is not as bad as it was anymore. See? So the worst is over. Things are better. Dollar's weak. Things are better. Isn't this nice? Joe says, just finished the first lessons in the swing trading course. You mean at FX Bootcamp, right? I just re-recorded the first one yesterday. Today I'm recording the second one. Okay, and I will move that over to FX Bootcamp. Right now they're on the I just did it like yesterday. So I've done it for the with the swing trading group, right? So I recorded live with the swing trading group. And by the way, if you're in my swing trading group at 11 o'clock this morning, New York time, I'm going to do the second training. So you can be over there. Okay. And so once that recording is done, by the way, I think the lesson was an hour yesterday. And then I had to upload it, which took an hour. I don't know. I had to render it, which took an hour. Then I had to upload it, edit it, which took another hour. And then I had to take that and put it on the course. So, you know, it takes a while to do these things. So anyways, so I need to do that. And so now I have those videos, and then I'll move them over to FX Bootcamp. And now they'll be in two places. Okay. So anyways, yeah. So anyways, thank you. Okay. So swing traders, 11 a.m. All right, let's move on. .com. Those are exotics. Let's take a look. Let's do gold and oil. At pivot points, Danielle. All right, gold and oil first. Oil, hey, it's moving along. It was slow. It was steady. Okay? Very slow, very sideways. We're definitely making higher highs and higher lows now. So earlier I said I felt it was still rangy but slightly up. And if you remember, I drew this channel because price wasn't really going up, but it was making higher lows, if you recall. So I drew it like this. Do you remember? And then I moved it like this. Now to adjust, it's steeper and in the upper, right? So now it's definitely trending if you're a bull, which is cool. But what was the winner chicken dinner of this? And that was when we were in here, I said, you must decide. Will this go from 50 to 60? Or will this go from 50 to 40? How many people remember that? And I said it's essentially a binary question. Pure mathematics, yeah, on the long run, but whatever. Okay, good. So I said that's the $1 million question. What happens next is just technical analysis. Okay? Remember, technical analysis doesn't tell you that. That's fundamental analysis. Okay? And then technicals tell you where to enter. How about a double bottom? How about a higher high, higher low? Okay? How about a higher high, higher low? It hasn't made the higher low yet, but if you're a bull, that's super easy. That's what you're doing next week. Done. See? Not a problem. All day long. Right? 60% of the time, it works every time. Okay? You're fundamentally bearish till year end. Well, the interesting thing about the oil market is that supplies go up in the spring and supplies fall in the fall. Maybe that's why they call it fall. Oh, I'm not sure. Maybe it has something to do with the leaves. But anyways, so as supplies dwindle, price tends to go up. Okay, Joe? But whatever. It's up to you, man. So in that case, it's not a demand equation, it's a supply equation. So if you want to know more about the oil market, I would recommend you go to the OPEC website, the EIA website, and the IEA website. Okay? With those three things, you're golden. You will learn a lot. Barry, what? Oh, pound dollar? No, I haven't worked over there yet. But why not? Why not? I need to point something out about the yens first, okay? Before we start specifically talking pound and Brexit and all that nonsense. Okay, I want you to confirm this. I know the answer and all this kind of stuff, but I want you to confirm to make sure you remember. Okay? And by remember, I mean understand. Do you remember me telling you that I know you probably made a ton of pips on this trade, but now it's over, you should be done. You should get out, walk away, and I said, this is where discipline's going to be, and you should probably take the rest of the month off, and all this kind of stuff, and hope's not a strategy. You made a ton of money, so you're going to hope it's going to go up even further. And I'm like, but no, that's not technical analysis, right? This is where bulls take profit. Okay? It's now been more than a full week, and price has not gone up. It stopped. Okay? It stopped. Okay? So you have to look at that and remember it and all that kind of stuff. The velocity was fast and furious, but that is where the market was supposed to get out. We knew that back here and back here and back here. And we knew if you're a bull, that bulls were supposed to buy somewhere in here. Then the market took off. And because that's the buy zone, this is the ultimate profit point. And you have no business trading above that. Okay? This is, and the amazing thing is, you know, is that Brexit? Is it not Brexit? I don't know, but that's beautiful technical analysis. And so, you know, buyers might be down here. Okay, so you see how this came down, kicked off of a weekly and reversed? Yeah, probably do the same thing. Okay, we'll see. But I need you to remember this for the rest of your life. This is exactly what I was talking about. You're feeling really good about yourself. You're so brilliant that you made all this money. You're finally understanding Forex. And now the money is just raining out of the sky. It's that easy. And then all of a sudden, it's coming back and you didn't get out. And no. This is not about genius. It's not about being smart. It's about being consistently a bull. And bulls know where to buy and bulls know where to take profit. And you're supposed to do your job. Not being right. So anyways, there's a great example of it. Great example. Even with that velocity, it did not break our rules of engagement. Okay? The rules of engagement I teach you as a swing trader and as any kind of pivot strategy is spot on 100%, and you need to believe it. Okay? You need to be emotionally committed, or you're just a poser, an observer, a lurker. Okay. If you go through many of the yen pairs, you will see many of them are at that level. You'll also see on many of the dollar pairs, many are at that level. See all these gray areas? These are all profit zones. We've already hit them. How do you get out of a bad trade? My stop loss gets hit. I don't have bad trades. I have losing trades, but I don't have bad trades. I'll get knocked out. What is it, 50 pips? I'll say, shoot, either the market sucks or I messed up and I entered at a stupid price. But there is no bad trade. There is no like painful loss. Like, oh my God, what am I going to do now? Right? My wife and children are going to have to like live in a ditch somewhere because I bought too much Kiwi Swiss franc. Like, that just doesn't happen. How do you get out of a losing trade? My stop gets hit. Done. But I'm not even watching it anymore. I don't even notice it. What's your average? 50. And then I move it pretty quickly. Honestly, I don't even see my trades get knocked out. Like, I don't even watch. Like, I don't care. You understand that? I have a trade plan. I enter it. I expect it to work. Right? That's it. I buy or sell something and I expect to make money. Just mentally, right? That's a big difference from a newer trader who's very worried about losing money. Like, I hope I don't lose money on this trade. No, when I place a trade, I expect to make money, and I'm a bit shocked if I don't. I don't mean that in an ego way, like, oh, I'm so right all the time. No, I had a very sound plan. And I bought at a good price. I know because I know technical analysis. That's all technical analysis is. If you're playing like a video game, you don't know how to trade. So I use technical analysis, and I'm a buyer, so I buy at support. And I buy at support either in a sideways trend, anticipating an upward move, or I wait for the upward move and then I buy at support. But when you do all of that, you'll probably make money. So I expect to make money. And when it doesn't, something's happened. The market changed. Or something. Or the market did something that it shouldn't have done. Or something, right? And then I'm like, oh, look at that. But most of the time, I don't even notice. I'll say, oh, am I still in that CAD trade? And I'll look and say, oh, no, I'm not on that CAD trade. Right? Well, not. I guess I'm out. But the thing is, I know what my stop is. So let's say my stop's always 50 pips. Okay? And typically after a day or two, I'll look at it and I'm like, oh, I'm profitable. So I'll move it to break even. And then do I care about it anymore? No, I'll probably have a take profit at an R2 or something. Okay? But see, these things happen throughout time, right? I enter a trade and the next day I come back and I'm like, I go through my charts again. So where are we? And I look at it and then which stops need to be moved. And the other ones, like if I don't see them, it's because I got knocked out. And I got knocked out. I don't even really see them. And there's no emotional consequence because I know the stops are small. I'm like, pfft. And then so that second day, the losers got knocked out. Now I just got my winners left, or ones that never got knocked out. And I might move the stop. So I might move it from negative 50 to negative 20 or negative 25, just depending on the price action. Right? And then I just go on to the next trade. I'm always, what's next? What's next? One thing that newer traders tend to do, and this is a consequence of being over leveraged, by the way. Newer traders are over leveraged. So what they do is they make one trade and they nurse it and babysit it. And they watch it go up 22 pips. Then they watch it come down 18 pips. And then they go watch it at 12 pips. And then go down 22, so now they're negative, and then it goes back to break even, and then it goes negative 30, and then you're like, oh, please go back up, and now you're begging for it to go back to break even so you can get out of your trade, which isn't actually, when you're back at break even, you're not losing any money, so I don't know why you'd beg for that. You should be begging for profit, not break even, and whatever, and it's all sort of weirdly backwards. Okay, but because I'm not over leveraged, I can afford to make 10 trades today, for example, and not worry about any single one of them. And you know, if I got 10 trades and they're all fundamentally strong because of my bias, and I'm using technical analysis to confirm the market is going in the direction of my bias, I have a strong confidence that they're going to perform. It's pretty rare for me to make 10 trades in a day and lose all 10. You see, and it takes time to add 10 trades. So if I was on my fourth trade and these are not working out, like I place one and place a second one and they're not making money, I rarely add a third one. You see, I'm just never in a situation. I'm never exposed to the risk of bloodbath. I'm a survivor. You understand? So when I'm winning, I like to trade. When I'm losing, I don't like anything. I'm certainly not going to trade when I'm losing, right? Does that make sense? All right, Danielle? Yeah. Yeah. Yeah, I can't afford big losses. Right? I can't afford big losses. I don't want big losses. I don't want to be in a situation where I might take a big loss. That's the secret to the rest of your trading career. Losing sucks beyond belief, and winning is wonderful. Ooh, look at this. Someone at Forex is cursing at me? What did I just say that deserved that? Forex? Did that come across wrong? I didn't mean it to come across wrong. It sounded egotistical, didn't it? I didn't mean it in an egotistical way. I'm trying to tell you that solid planning fundamentally and using technical analysis, both long, medium, and short term, put together puts me in situations when I trade that are actually, like mathematically even, more likely to perform. But if they're not performing, if I do all of that and I enter one or two trades and I'm losing, I'm not going to enter a third. But when I am doing well, because of all the hard work I did, I will do it. Like, think of it. My opening quote in my book, it comes from The Art of War, and it says, an honorable general wins because many calculations were made. So I'm talking about, because of my many calculations, fundamentally and technically, and me sitting around waiting for them to align, I'm more likely to win than lose. But if I start entering in my trades and I'm losing, I stop entering trades. So I didn't mean it as egotistical. Forex cursed me out, and you can't see it because YouTube blocked it. But I didn't think I deserved it on that one. Sometimes I do deserve it, but I didn't think I deserved it on that one. Well, the thing is, Joe, the don't lose big is difficult because people come to the market, right, with the idea of they want to win big. The only way you can win big is to risk big. And when you risk big, you lose big. The secret to making money is time. I want you to think about this. This is what finance is, by the way. Finance is the valuation of cash flows. Okay? So my degree, my first degree is in macroeconomics. My second degree is in finance. It's management and finance, right? Harvard's the best strategic management school on the planet. It just is. So I'm in the strategic management program, but with a concentration in finance, right? So the finance, the art and science, it's really science. The science of finance is the valuation of cash flows. The secret to finance and wealth is time. Okay? The sooner you put money somewhere and the longer it sits there growing, the more money you're going to have at the end. And it gets bigger and faster at the end than in the beginning because of things like compound interest, right? You need to think of your trading career, listen to my word choice. You need to think of your trading career as long-term cash flow. The less you pay yourself now, the more money you'll make in the future. Because your account grows. And then what do I tell you? Lower your risk per trade over time. Okay? So eventually, at some point in your career, when your trading account is big, but your per trade risk is low, and you go through a bad period, percentage-wise, it's not going to cost you much. You'll have a horrible month and lose 3%, and you'll be kicking yourself. You're like, I'm so upset. But you're a survivor. And then the next month, you make it back. Because it wasn't a big deal, right? You want to get to a point where you're mediocre trading. Mediocre meaning you never hit it big. If you're a baseball player, you never hit home runs. Okay? You're not even trying to hit a home run. Okay? Whatever the analogy you need. Hard work, focus, discipline, effort over long periods of time with low risk will yield a consistent and reliable cash flow, of which you, in the beginning, try to save 100% of it. See if you can go 5 years without paying yourself. You will do so well financially. See, like if you take out 50% of your money every month of your profits and only save 50% of your profits, it'll take a very long time for your trading account to grow. But if you, let's say, in your first year didn't pay yourself anything, you saved 100% of your profits, then in the second year, you'll be making so much more per trade. And maybe in that year, you pay yourself 25% of your profits and save 75. So at the end of your second year, your account will be ginormously bigger than your first because you're saving almost everything. And now per month or per quarter, whatever you're doing or paying yourself at the end of the year, whatever it is so much. You're making 8, 9, 10 times more money at the end of year 3 than otherwise, because you didn't pay yourself anything in year 1. You only paid yourself a little bit in year 2. By the end of year 3, instead of you making $1,000 a month, you're making $14,000 a month. Why? Your account size is bigger. So I want you to look at things like this as long term. Literally, if you have the capability, bust out an Excel spreadsheet and do cash flow statements. Okay? If you have the capability, do it. What do you make per month? Right? On average, grow that. How much money will you have at the end of year 5? How much money will you have in year 10? How much money will you have 20 years from now? And then adjust how much you're paying yourself per, let's say, per quarter, 10%, 20%, 30%, 50%, 90%. And you'll find like there's radical differences, right? And then you'll also find, like I found, that whatever you're trading now is crazy over leveraged lot size wise. So you'll see, oh my God, you'll see it. You'll just see it in the numbers. You're like, this is crazy money in 15 years. It's so much money. You're like, clearly you shouldn't be trading lot sizes this big, because by then you would never do it. You'd never drop $100 billion on a trade. You're like, the numbers are too big, so you must be over leveraged now. So as you make more money, because you need to grow your money in the beginning, and if you're growing your money in the beginning, don't pay yourself, and then start reducing the risk, because in 5 years and 10 years, 15 years, your risk per trade should be nothing. And you'll be like me, like losses, I don't even pay attention to my losses because they're small, they're irrelevant, they're a cost of doing business. They're all good trades. If I'm a bull, every trade I make is at support. If I'm a bear, absolutely every trade I make as a bear is at resistance. They can't, by definition, be bad trades. They're only losing trades, and I don't pay attention to losers. I love my winners. I babysit them every day. I go, oh, look at my Euro Turkish lira, right? My Euro Turkish lira, right? And I look at it for 1 second. I'm like, good trade, bro. But then I move on. What am I going to do today? What's tomorrow's trade? What's next week's trade? What's next month's trade? What am I going to do in January? I'm already planning these things out, but my losers, well, I got stopped out. Yeah, I guess, like someone asked me the other day, well, what happened? I had those 2 small Euro Turkish lira trades, and the market, we had a big bull run on that Euro Turkish lira for about 2 weeks. Someone said, well, what happened to them? I'm like, oh, well, I guess they're not there. I got knocked out. Yeah. I broke even on 2 small trades. Huh. But I'm not like sweating bullets over the fact, what did I do? I got in another good trade, and now that one's making money. You see what I mean? So anyways, I learned all this from hard work. I learned this from being a venture capitalist. I learned this from being a business owner, all before Forex. Okay, I was a successful entrepreneur, right? And I was a venture capitalist. So I think in terms of what's the cash flow? What's the risk? What's the investment here? What kind of risk am I taking? What kind of returns can I count on? You imagine as a venture capitalist, how many times I've heard an entrepreneur tell me that they're going to make $1 billion in their first year because everybody loves their product? I'm like, let's go through the numbers, bro, right? So this is the way I think. Okay? That's what I brought to Forex. And now this is what I'm sharing with you. I want you to think about your Forex not as a get-rich-quick scheme, but as a long-term business and career. This is what you're going to do for the rest of your life. I've searched the world. There is nothing better than what you have in front of you right now. There is nothing better. There's probably easier things when you have money. So once you got, let's say, $10 million in disposable income that you have no use for, you can buy a whole bunch of real estate and just earn 8% a year on your 10 mil. But until then, you're going to need to earn it. By the way, what's 8% on 10 million? 800,000 a year. Done. So maybe you only need 5 million. But you know, the more doors the better on real estate, right? The more people paying you rent, it's like lots and lots of little trades versus one big trade. I'd never buy one house, right? I wouldn't want $1 million house. I'd want $100 million building. That's how I look at it. Anyways, so the more doors, the better. Okay. Same thing with trading. I would rather have 100 small trades than one big trade. Why? Because my risk is spread out across 100. And by the way, if I got 100 trades open, they're all profitable. Why? Everything else got knocked out at break even or I lost money. When you have 100 trades open, you will have nearly or completely 100% available margin. Pure mathematics says it's like hedging. I'm not sure if you're commenting on if you're making a comment or if you're commenting on my comment, but if you're commenting on my comment, it's more like diversification. Okay? Let's say you own a house and you rent it. So a friend of mine, he owns 8 houses besides the one he lives in. Okay? But let's say what happens when a renter vacates the property? 1/8 of the income has gone down. 1/8. Or if you're just starting out, what if you have an income producing property? You own one house and you rent it out and they decide to vacate. Now 100% of your income's gone. Now what do you got to do? Paint all the walls, replace the carpet, advertise. You need to interview a bunch of people. You still have to pay for the lawn. You still have to pay for the insurance. You still have to pay for the electrical. You still have to pay for everything. Whatever. No renters, no rent. And then you got to go through and do background checks, $50 a pop on everybody, and do their credit checks and all that kind of stuff. And finally, 2 months goes by, you get a half decent renter, and you were a little desperate, so you put in someone with mediocre credit, and boom, they're back in. But the thing is, a percentage-wise of your annual income, with your right, you've lost a huge percent of your annual income, and yet your expenses are still high. So at that 1 month or that 6 weeks you were not collecting rent, just basically took your entire year's profit. So if that happens every 3 years, let's say every 3 years you don't make money. Sucks, right? I'd rather have 100 doors in one building, one lawn, one roof, right? One electricity bill, one management company, 100 people paying me rent. And if I have 8% vacancy, that's normal, but I can count on my 92% revenue. The expenses are basically fixed. There's very little volatility and all that kind of stuff. And then boom, right? So anyways, until you get to that point, you need to make money here. And there is no better way to make money except Well, I won't mention those things because they're not legal. Okay? The best way is like charge Turkey 1,100% for a loan you gave them when your cost of the loan is zero. Think of that. I'm a loan shark to sovereign nations, to emerging markets. I'm a loan shark. Love it. Completely legal. Turkey is short on euros. They're desperate. Okay? You see what I mean? Yeah. I'm lending Turkey euros. I don't have euros, so I had to borrow the euros. Europe gave me their money for free. I'm like, cool. So then I take my euros. I'm like, hey, Turkey, you want to borrow my euro? So I charge them interest. 11% interest. I charge them 11% interest, right, on my $10,000, or sorry, 10,000 euro loan to them. So I gave them 10,000 euros. I charge them 11% annually, but I only have $100 of my actual money risked. That's awesome. All day long, man. I mean, seriously, I've looked at thousands of patents. I've looked at thousands of business plans. This is the greatest job in the world. It's absolutely mind-blowing. The Europe would give me money for free. I just have to pony up 1% collateral or even 0.5% collateral to get free money. And then I can loan it to somebody for 11%. It's awesome. Okay? So you want to do this for the next 20 years? Start thinking that way. This is a legitimate, legal business, and the opportunity is mind-blowing, and you want to do this the rest of your life. And you need to think that way, and you need to act that way. And the first thing that most people do when they get a professional career is they get education, they start taking it seriously, they right? You understand? You're in it to win it. The other 95% are posers. They're unwilling to do the work, or they're incapable of doing the work, and I don't care because they pay my bills to Harvard, right? That's what the lazy, the sick, and the weak do in the marketplace. They're not capable of doing the hard work. They're looking to get rich quick. Their trading sucks technically. Fundamentally, they have no idea what they're doing, which is great for me because when I make a trade, it's the best trade I could possibly make, and I expect to win. Yeah, Michael, absolutely true. If you have 1,000 trades open and they're all winners, what's your available margin? You have $1 billion worth of trades open right now. What's your available margin if they're all profitable? 100%. Because in Forex, you can trade your winners. When you own stock, see, I bought Apple Computer at $6 a share. What? I bought stock in Apple when it was technically bankrupt. Yeah, boy. And I sold it when it was the biggest company in the world. Think of that. Hey, you want to know how to get rich? You should buy a bankrupt company and then sell it when it's the biggest company in the world. Dude, you just have to do that. So I actually did that. Okay? But as it doubled and doubled and split and went up and up and up and up and up and up, can I spend it? I can't spend it, guys. I can't take my money that I've made, so it went from $6, split, went to $1,000, right? Like I made something like 100,000% return on investment or something stupid, right? But the thing is, I can't spend it. It's paper money. It's nothing. You can't spend it until you sell it. So I sold it shortly after Steve Jobs died. Okay? So you can get an idea. I was in it for a while. Okay. In Forex, if my Apple stock was instead traded like Forex is traded, as it went from $6 and then split, so doubled, right? And then went to 1,000. So it's basically like my $6 stock was worth $6,000, right? The thing is, as it's going up in value, the money is already in my account. In Forex, you're paid in real time. You're mark to market, paid in real time. It's in your account. So as you're collecting your profits and all your trades are profitable and all your trades are at break even, you have all that money you've made on your open trades in your account available to trade. Do you understand how ridiculously amazing that is compared to other markets? It's amazing that you can do that. You can't do that in the stock market. You can't do that in real estate. Your house goes from 1 million to 2 million. So what? Nothing's changed. You're like, oh, well, I can take the equity out. No, you're just converting equity into debt, which is also another piece of paper. So now you owe $2 million to a bank on your house instead of one. So now nothing's actually changed. So you could take your $1 million and then pay back that loan, and now you're back to $1 million. Like it's not there until you sell it. You paid $1 million for your house. You sold a house for $2 million. Now you have $1 million in your pocket. But now you don't have a house. In Forex, you got the house. It's gone up $1 million, and the $1 million is in your account. Your debt didn't go up. You didn't convert anything. It's cash. You can spend it. You can take all that money, retrade, right? Pay yourself, buy your yellow Lamborghini, and all those trades are still in the market. It's amazing. It's unbelievably amazing. This opportunity you have in front of you. You can grow and grow and grow as fast as you want in Forex. It's amazing. A normal business could have high growth, but the consequence is poor cash flow. And if your actual growth is above your sustainable growth, you can grow, add more and more customers and go bankrupt. In Forex, if you save all your money and lower your risk over time, it's unbelievable. It's the greatest business in the entire world. And yet many people, they show up and they're like, I want to get rich quick. Well, I'm sorry, bro, it doesn't work that way. And we know 95% of people that think that way, actually 100% of people that think that way fail. It doesn't work that way. You're in the wrong game, bro. It's not how it works. Low risk, steady returns, add time. This is a long-term thing, and it's the greatest thing in the world, and it's going to set you free. And nobody cares who you are, who your daddy was, how well your mommy can dance, what school you went to. Nobody cares. Nobody cares. What town do you live in? What country do you live in? What language do you speak? What God do you pray to? Nobody cares. Nobody cares. Nobody cares. It doesn't matter. It's amazing. What location are you in? Where's your office? What suit do you wear? Nobody cares. Nobody cares. It's wonderful. Okay? So don't screw it up. See you tomorrow. All right, have a wonderful weekend. Peace on earth. May the pips be with you. May your profits be above average. Thank you for the thumbs up. Thank you for all those likes. Thank you for the respect you show me every day. Thank you for the respect you show your fellow traders. And then please subscribe to the channel. And please visit tradersway.com and open an account today, just out of loyalty and respect for them making this available to you every single day. Pay it back. Do what's right.